Hello, and a very warm welcome to this session of the Oxford Africa Business Forum. My name is Pelumi Olawale, and I'm incredibly excited to have you join us from around the world for this session on innovating the investment gaps in Africa. In this session, we'll be exploring the future of fundraising in Africa, including innovative opportunities to empower local African businesses and early stage startups. Another thing we'll be looking at is the rise of debt and equity co-funding models in Africa. And our objectives for this session are simple. First of all, we want to have a dynamic discussion around the pressing issues of investing in Africa. Secondly, we want to highlight the amazing opportunities inherent in this interconnected ecosystem. And more importantly, we want to show that there is potential for rewriting the capital narrative of the continent. On the panel today, I am joined by an amazing lineup of speakers from across Africa. First off, we have Bogolo Kenewendo. Bogolo is the former Cabinet Minister of Investment, Trade and Industry for the Republic of Botswana. She's a brilliant economist and currently serves as the Managing Director of Kenewendo Advisory. Next, we have Iyinoluwa Samuel Aboyeji, popularly known as E. He's the co-founder of Andela and the former managing director of Flutterwave, one of Africa's fastest growing payment platforms. More recently, he founded the Fund for Africa's Future, which aims to provide capital, coaching, and community to mission-driven innovators across Africa. Next, we have Kirtika Challa. Kirtika heads the Tunisia advisory business of CrossBoundary Investments, and she has a breadth of experience across trading, financial planning, infrastructure, and she's really passionate about helping entrepreneurs, raise funding in traditionally underserved markets. And last but not least, we have Saad Sheikh. Saad is a principal at TLG Capital, where he sits on the investment committee, and he looks after TLG's African interests. So welcome to all our panelists. I'm absolutely delighted to have you here today, and we'll dive right in.
Glad to be here.
Awesome. So the first question goes to Saad, and here it is. So attracting capital to Africa has always, been a value-driven exercise, and anywhere else in the world for that matter. Africa is often touted as the next investment frontier, and the irony is there's still relatively very little in the way of committed capital, to Africa, compared to other jurisdictions. How do we begin to solve for this? And more importantly, how do African countries begin to attract the right type of capital?
Pelumi, thank you. Great question, and thanks for having me. First of all, absolute pleasure. It's a bit of a dichotomy. You're right. The challenges for Africa, and then connecting that challenge with capital. First of all, we've got to understand Africa as a continent, unfortunately, is still seen as a stepchild of the entire world. The premium that is charged for returns on African continent is higher than what investors expect in, for example, India, Southern America, even the Far East. And the reason for that is, my view, is people don't understand Africa. A lot of people talk about Africa, but they don't realize that it's a number of geographies that are linking the continent together, each with its own dynamic, each with its own requirements and cataclysmic activities as well. I've been in some significant issues on the continent, be it Nigeria during the dollar crisis, during Ebola, during COVID, or in Liberia when the Ebola crisis hit, in Uganda during elections. So I've seen cycles of misdemeanors, activities that don't happen as they need to. But then Africa is so dynamic, so huge, and opportunities are oozing that you'd be silly to miss it out from your asset class. So with that backdrop, what I'd like to talk about in terms of capital, and that's what we do at TLG. We're a private equity, private credit fund, and we've been deploying capital on the continent for over 10 years now. but we had to tailor our model. The capital is required at the SME level significantly because there's a missing middle, there's a gap. There are banks that are serving the corporates. The bottom of the pyramid is unbanked. The middle sector, which is the SME, is capital starved. So that's where we fit in. We like to do deals between $5 to $15 million transactions, smaller as well, and that's where the VC opportunities kick in. But that range of capital is really not something that the big PE funds like the Helioses, etc., even large DFIs look at. CDC, for example, wants to do everything above 50 million. So there are limited opportunities on the continent at that level. Surely a lot more in North Africa, and I'm sure we'll hear more about that. But sub-Saharan Africa, where we focus, I think 5 to 15 is a very interesting ticket size. Now, about tailoring that to the needs of SMEs, that's very important. And again, a couple of backdrops. The market is illiquid, right? We know that for a number of reasons. We blame the governments and regulation very easily, but we have to understand the ecosystem as well. Yes, the IPO market is very illiquid, but look at the layers below it. Even the DFIs don't offer secondary funds. VCs have gone in and really transformed early stage businesses, but there are few and far between secondary opportunities. Who are they going to sell down to? Haystack is a perfect example. They came in and bought it. They created a secondary market. More of that needs to happen. As a consequence, what we're thinking about, excuse me, is creating a layer of secondary fund opportunities across the continent. So not only are we a growth capital provider, where we'll go in and provide the capital to help businesses grow, we're also thinking about how to improve the ecosystem and secondary business models. But I'll return to you with one thought, that capital in Africa needs to be nuanced. We were initially investors as pure equity, but very quickly realized due to this illiquid nature, there's still opportunity to invest. You have to tailor the product. So we did a hybrid model, credit or debt with equity upside. What that means is we still act like equity investors. We still sit on the board. We still do everything an equity investor would do. But that self-liquidating investment vehicle really works. And it also gives entrepreneurs the opportunity to retain equity. In Africa, you see a lot of that. And I'm being a little bit more generalist right now. Entrepreneurs want to retain more equity than give away. That's more so in Africa than any other jurisdiction. So with that nuance, I enjoy investing in Africa as long as you can be nimble, which thankfully we are. So back to you, Pelumi. I hope I've answered it.
Absolutely. I think you've raised two very important points. One is that there is an underserved market. The problem is typically more complex, just a lack of capital. The problem, is usually where that capital is deployed. And I want to pose, this question to Bogolo. So Saad has raised important points around attracting the right type of capital, investing as an equity holder, but also guarding your risk parameters, just like you would a debt instrument. And Bogolo, can you speak to raising nuanced capital in Africa in your experience, and what innovators need to keep at the back of their mind?
Right. Well, first, good morning, good afternoon, everybody. But first, I think we need to take this issue that has been said quite often. Can you hear me?
Yes, absolutely.
Okay. That has been said quite often, that there is no capital, there is no capital to flow to the continent.
Is so much liquidity internationally, and it's just that capital is not being directed to the right productive purposes. and not being directed to some of the economies that need it. And so in our experience dealing with FDI, and I take it that's what you're referring to for me, when I was the Minister of Investment, Trade and Industry, we went out canvassing for FDI. And one of the main issues that we had to deal with quite often was the issue of, are we trustworthy, issues of corporate governance, issues of investor protection. And some of these come up quite often in different rankings, with WEF competitiveness, with the World Bank doing business rankings, and they need to be addressed. And, you know, even in various reports, I mean, last year, the World Investment Report highlighted that Africa was going to see a shortfall of about 40% of investment because everyone is fleeing unstable markets and going to more stable markets, even though we know that the stabler markets are not generating the same level of ROI as emerging markets are doing. So the issues that I have touched on are what is seen, even in that report, were what is seen as a main factor for investing in the continent, or main challenges for investing in the continent. And as a country, as a representative of the government, we had to quite often deal with that. But beyond just dealing with governance, because now we're talking about Botswana is there, Mauritius is there, Cabo Verde is there. We all have good governance. We have systems and institutions in place. So now what is it that we are offering beyond just our institutions? Now that's when incentives come into play. And the way that we position ourselves as countries, as cities, municipalities, how we position ourselves. Are we more looking at export development centers? Are we now looking at industrial hubs, or what it is that we can particularly tailor ourselves to attract a specialized kind of capital into those countries? And for innovators, because that was more for those with capital and countries, but specifically for innovators, it's also, you know, finding a center. So if we're looking at a country, finding a center that really is reforming and more accommodative to you. And we had started really pushing issues around sandboxes so that, you know, it's not just about capital, because I mean, we talk a lot about the capital side, it's very important. But once you have the capital, are you actually able to do business? Right? Is your capital going to be productive? And if we're not providing the sandboxes for regulation to allow you to innovate and be creative in what you want to do, then, you know, innovation will never really thrive in the continent. And we've seen so many cases of that. And I can say so much on this, but I'm sure you'll come back with a question later.
Yes, absolutely. And just staying on that topic, you know, real quickly. You speak about creating, you know, a nurturing environment for innovators and investors. What reforms do you think are needed, both you know, in terms of legislative infrastructure, in terms of physical infrastructure on the continent, to create this nurturing environment that you've spoken about?
Right. Okay. So now you're pushing me to an area looking at the theme of today, that I think there is a need for us to also innovate and be creative in our legislation to be more accommodative of innovation generally, and more accommodative of capital, of the right capital. So we have two sets of issues to deal with here. It is innovation in infrastructure, so physical infrastructure, and then innovation in legislative infrastructure. Because many of us, especially those with a history of good governance and democracy and institutions, we have a legacy of these kind of legislations that do not really embrace the new kind of technologies, or do not necessarily embrace innovation. So we need, as people in the public service, I still refer to that. So I'm gonna need to start defaulting to more of the private sector. But as governments, those that work in public policy need to really innovate, particularly in legislative infrastructure, reforms in doing business. So how long does it take you to start a business? You know, when I was minister, we did the OBRS, so the online business registration system. It used to take 49 days to start a business in Botswana, and now it takes less than 7. And it's all because now we've innovated how to start a business, how to register a business. And those are things that are very crucial because time is money, right? And you don't want to spend too much time in just dealing with the small administrative issues. But over and above that, when we look at different sectors, I mean, it could be new way of HR, it could be fintech. Sometimes our legislation is not ready. And when you're not ready, create a sandbox. Learn while people are doing, see where the opportunities are. Is there anything that is a significant harm to the society? And if there isn't, then deregulate, delegislate, and keep it open, but keep an eye on it and see if there's anything that really needs to be done. Because I think, in my opinion, less regulation is better for business rather than us incumbing startups in particular with a lot of legislation. And when you simplify things for the small guys, even the big guys tend to flourish. And that's how we really need to look at it and understand what the startup culture is generally and who we're trying to stimulate here.
Absolutely, absolutely. I think you've raised very important points around just learning, particularly on the regulatory front. Creating a sandbox, when you're not clear, and just moving from that perspective. We have a question here from the audience for Kirtika and Saad. Kirtika, you'll go first. So the question reads, there's a huge depository of local funds that can be used to help private sector firms, such as pension funds. Do you think it is a problem of funding, or do you think it's a problem of infrastructure unavailability, that are holding, back transparency and liquidity in this private sector markets?
Yeah, sure. I feel like there are so many topics that Saad and Bogolo spoke about that I resonate a lot with. But yeah, in terms of the question, completely agree, right? I think, a lot of financing is hard currency, unfortunately, in this market. It comes from funds that have LPs that are hard currency based. And so FX depreciation ends up hitting the companies really hard, right? Even if you perform really well, if the Naira is going to go from 360 to 440, it's impossible to grow at that rate. And on the flip side, there is this local funding that tends to go towards, treasury bonds locally. I think the struggle is, when the local treasury market is offering 17 to 20% by just putting your deposits in the bank, how does a private entity compete with that, right? But I think there are really good impacts that can be created, and there are really good local pools of capital. So I would say 2 main ones for me that we're trying to work more with in a lot of our markets with CrossBoundary is high net worth individuals. I think a lot of early stage VC funding is through VC funds that, again, tend to be hard currency focused, but there are a ton of high net worth individuals that would like to make that impact, right? They've created local firms that have succeeded. They want to give back to the society. They want to be involved in innovation. How do you mobilize that capital to go from either investing abroad in USD to investing in local entrepreneurs and mobilizing the high net worth pool of capital? So I work with. And then partnering pension funds with long-term viable project finance projects is definitely a path that has not fully been explored. So I think renewable energy is a big theme in a lot of markets. Africa as a whole, lots of solar power, lots of untapped solar power. I think governments are trying to do a lot with tender projects. So there's sort of the utility skill, but there's also distributed energy generation, right? So working with an industrial or a commercial player, partnering a large solar project with them, and then trying to get long-term financing to team up with that. So I think there's barriers and issues, but I think that is a huge untapped pool of capital that is slowly starting to open up. And we as advisors, CrossBoundary, are trying to work with pension funds, high net worth individuals to try to unlock this a bit more.
Yeah. Absolutely, absolutely. I think you've raised absolutely great points there. Saad, what are your thoughts around the narrative of raising private capital and deploying that in as efficient a manner as possible?
Sure, very topical indeed. I'll give you two examples. I'm talking to one of the largest banks in Nigeria at the moment to set up a private credit fund for Nigeria. And they are the distribution arm. They will be tapping into the pension funds. They'll be tapping into ultra high net worth individuals, and we will then be offering products that we as TLG can structure, can originate, and then gets distributed. It's a very interesting model, and I'm doing that in Tunisia as well. Kirtika, funny that you're sitting in Tunisia at the moment, but the CDC of Tunisia had an initiative called the Empower Fund, or at least a part of the larger initiative of $100 million fund, where they want that capital to flow in a local currency, or Tunisian dinar, to flow into the local economy, into the SMEs, to bolster support post-pandemic. We, as with significant experience on the continent, are coming in to help both. We have the technical and the ability to not only originate but structure deals very effectively. And it's all in our track record that we've given yields of anywhere between 10 to 12% annualized in dollars. Something that Kirtika mentioned about local currency depreciation. We've been through that. We've been through the Naira depreciation from 380 to 480, I would say, because the parallel market was at 480. And regardless of what your return is, 20, 30, 40, 50%, there's no way you can catch up with that forward depreciation. So we did, because we have the FMBG hedge, etc. But long story short, it's very topical. I think, again, it's all about being innovative. I think that local currency angle is huge. And we do need to tap into that. And I have started doing that, which makes it very topical. And I'm doing it in 3 jurisdictions: West Africa, East Africa. East Africa, I'm creating a secondary fund, local currency, supporting the banks that are going to almost be hit quite considerably. So supporting that with almost like an arm of turning around businesses. So again, you need to be innovative, but it's a big, big pool of capital that can be tapped. And we've started doing it. So I think phenomenal question.
Yeah, and maybe just add one additional point. I think also like more partnerships, right? Like Saad was saying, there are also assets that require both pools of capital. So if you think about, again, going back to solar power, right? The capex is often either euro or USD denominated, because you buy solar panels and they tend to be in that currency. But the OPEX is going to be in local currency, and your tariff is going to be in local currency. So if you can structure the revenue to align with the costs, which is what Tunisia is doing. So in Tunisia, you have 85% of the tariff, which is denominated in hard currency, and 15% in local currency. That allows the developer to access both pools of capital and be able to sort of naturally hedge the FX risk. So I think thinking more innovatively about partnerships between both those pools of capital also will go a long way.
Absolutely. So partnerships to bridge otherwise siloed pools of capital. I think that's an important point to note. The next question is for Iyinoluwa. So there are more and more positive perceptions about the future of continent. You are one of those people who is incredibly passionate about the future of the continent and constantly pushing to drive growth opportunities in the businesses that you start. What can you speak to about the lack of confidence, as it were, in Africa currently, as evidenced by the fact that less than 3% of foreign direct investment on a global level flow, to the continent? What do you think, solves for this lack of confidence?
Thank you very much for having me on. I've learned so much from the other panelists and all the amazing thoughts they've shared with us. I think, broadly speaking, the reality of investments on the continent is that there are not many believers, and they tend not to be in the beginning. And there's actually many good reasons for people not to believe for now, because we do have governance challenges to overcome. There are huge infrastructure challenges. There are huge talent challenges. And as we have discussed on this call, there are real financial risk challenges with investing on the continent. So if somebody is looking for a food is ready investment opportunity, we're offering raw rice. And so we should not call it jollof, right? However, for people like myself, I see these challenges as opportunities, right? There is an opportunity to create the kind of environment that some of these investors would be excited to participate and work with us on. Sorry. Apologies. We can create the right kind of opportunities for us to be able to attract that investment. And I think that's the challenge. The challenge is, are we ready to do the work to create those opportunities? And if we are, then it shouldn't matter what anybody else thinks, because when we do the work, they'll come along for the ride. But somebody has to do the work. And the reality is, for someone like me, there's nowhere else where I have the networks to do the work, right? Where I have the opportunities to do the work, where I have the local context and knowledge to do the work required to make this an investment destination. And so if we do the work on the ground floor, I think the entire ecosystem will benefit as a result. Thank you.
Pelumi, can I just add on that a bit? Yeah, I think there's so many things that he said that resonate, and I think part of it is also just setting the right expectations with capital, right? I think investing in San Francisco or the US in VC, you expect a unicorn, you expect this like accelerated growth, but that's because a lot of the infrastructure exists and companies are building on top of that. In Africa, you are building the infrastructure along with your company, right? Like Flutter, for example, like is building this digital infrastructure that doesn't exist. And so companies will not grow as fast, but as they're building this infrastructure, the growth will accelerate. So I think, capital just needs to be structured maybe a bit differently, be a bit more patient, just understand that this first layer of innovation in Africa is going to be slower, but it'll build sort of the foundation that the next layer can sort of accelerate on. And I think the second point is that there are really good sort of almost low-hanging fruit, right? I feel like, in the developed world, you're trying to, it's a bit of a bubble, right? Like with the Dogecoin and Greensill and all of these like insane unproductive assets that a lot of capital is flowing towards. It kind of feels like, what's the point of that money? But on the continent, you can invest in, real agri-processing, healthcare, education, fintech, growing SMEs. And so I think, the story is just much more interesting and much more impactful, but the capital just needs to be structured slightly different.
Yeah.
And if I could just jump in on that, it reminds me of a conversation I had a few weeks ago of an investor who was saying, I would like to see 20x growth in this particular sector. And what it turned out was that the business was actually growing more than that, right? But you don't have, when they don't understand the dynamics in the continent, what is the population? It's not China-sized population. It's not India-sized population. You could have a business growing exponentially and your investments doing well. But if you don't understand the context at which that capital is being invested in, then, we completely miss it. And I really liked what he was saying about really being patient and understanding where you're investing, because you can't, in the continent is different. You can't just throw money and expect to have your return in 7 years. So technically the PE model, we challenge that quite often, because it's not going to take 7 years. You're going to build the infrastructure and help build the business at the same time. So patience is important. A real interest in the continent is important. You can't just throw money without actually seeing what things are and understanding the context at which that business is operating, because it's not just the market issue, but it's also playing with the legislative issues, the politics, and all the risks that come with being in an undeveloped market. But what we can say is everyone knows that the next growth frontier in the world is in the continent, is in Africa. And so it's worth taking that risk and growing together. But, you know, as I said the other day, Pelumi, it's not just about investors taking the risk. It's also about us, what we're doing when we are asking for capital to flow to the continent, how we protecting that and ensuring that it grows at the same time.
Yeah, absolutely. I think, I mean, coincidentally, you just answered the next question, which was sort of around how to treat capital, because essentially, I remember in one of our conversations, you know, the theme around how do you deal with a guest in your home who sometimes behaves badly? You know, I think that's a very African concept. You know, and sometimes you have to deal with that, but it's definitely something interesting that will have to be looked at. I would just like to, at this point, introduce our fifth panelist. Her name is Moremi Aboyeji. She's an expert on everything Nigeria. You know, she has successfully founded multiple real estate companies, I'm sure. Can we just say hello to Moremi? Okay, so moving on to the next question. So this next one is for Saad and Kirtika. So the theme of this forum speaks to using unique funding models for African businesses. So in your experience, what has worked so far? Will it continue to work? Kirtika?
Yeah, just a quick clarification. It's Kirtika rather than Kirtika. No worries. Yeah, I feel like there is a lot of, you know, innovation that could be made on financing, and I agree with Saad completely that the gap exists between like 5 million and 20 million. So you have like incubation, you have early stage VC, and then you have like the DFIs, you have the Actises and the Helioses of the world that are doing like 20, 50 and above. And so like it's tough as a company in between where, you know, you've got the VC funding that expects a lot of growth, but there's no growth funding to actually get you to the next stage. And then I also think, you know, there's a big role of like blended finance that can be played in this, right? I think we often think about you know, grant funding as one option and then private funding as the other. But if you think about it from a return perspective, pure grant funding is sort of like negative 100% return, right? You're not getting any capital back, and you're not getting any additional capital beyond what you invested. And then private funding is probably looking for 15 to 25%, and ideally more. You want to make a lot of return. But that's a huge range between negative 100 and positive 15 to 25, right? You could, I think if you can bring those two pools of capital together to create blended structures that align with the sector you're looking at, that align with the impact you're looking at, there's a huge amount of growth that can be achieved. So like one example I'll give is in Nigeria, we were looking a lot at energy access. So, you know, on the continent, 600 million people don't have access to energy. In Nigeria, it's a combination of access and reliability. Almost everybody has a diesel genset, very loud, very polluting, very unreliable. And off-grid access to electricity cannot sustain private capital, right? It cannot give you 15 to 25% return reliably. There is no contract. These are people that low income, maybe not reliable, but do want electricity and it will make them more productive. So if you can find a way to get maybe anywhere between 25% to 75% of the asset funded through grant funding and the rest through private capital, it just creates more mobilization of capital and it creates more alignment with what the asset can actually deliver. And you know, you can purely private fund commercial and industrial solar, and you need, I would say, probably 50% grant funding for very, very rural electrification. And I think those two pools of capital just need to find a more efficient way to partner. And I think that'll go a long way for a lot of assets.
Yeah. Saad?
Pelumi, always the tough questions, huh? It's a very good question. And let me give you examples of what has worked and what hasn't. And we've been doing a little bit of study around it. So again, very topical indeed. We're obviously an open-ended fund, and I shouldn't say obviously, but we're an open-ended fund because that's the one that makes most amount of sense. One of the statistics that we've seen come out of the DFIs is last 5 years, 5 to 7 years, 2012 to 2018. That's about 6 years. PE returns have been 2.5% dollarized, 2.5%, right? And PE in Africa is targeting above 25. The range that Kirtika was giving was, it's kind of the higher end of that.
Yeah.
Our returns are 12%. So we're kicking the backside of PE like there's no tomorrow, right? So there's something that we're doing right and they're not doing right. Yet 95% of capital that flows onto the continent is into PE funds. Last 10-year returns, less than 5%. Now, let me tell you what has and what hasn't worked, right? So we did private equity first 4 years of the fund. We invested in things like Cipla Quality Chemicals in Uganda, flagship on the continent, AIDS and malaria drugs manufacturing, exports to 11 countries on the continent, 2 off the continent, partnership with Cipla, a behemoth in generics manufacturing out of India. You can't go wrong. We listed it in 2018. We went in at $25 million, listed it at 255 million. Kudos, 10 times return. But guess what happens? 2 years in, it's trading at $100, at 100 compared to 255 that it should have, right? Rather than going up, it's considerably receded. So now we're kind of thinking, what a poor decision, right? Because we didn't exit at the time we listed, because we thought the next step above AIDS and malaria, we're now going to Hep C. We're also doing oncology. What can go wrong? That's how we were thinking. But boy, were we wrong. It's trading at 85 actually. Yesterday I checked, 85. It's disaster, right? So what not to do in Africa? Go in IPO and then think that that's the way forward. Don't do it. Right? We were so happy we made 10 times return. We're talking about performance fee vaporizing. That's what's happened. But then what has worked? Uganda again, just to kind of keep the dynamics the same. Fuel retail, which a lot of DFIs would say, we don't like it. But this is an indigenous guy with 4 fuel stations in the middle of kind of rural parts of Africa where people had to walk miles to get fuel. He's put a fuel station there. 4 fuel stations when we went in, 44 when we came out, IRR of 38%. I kid you not, 38%. I exited on the 24th of December to a PE fund, gave them my warrants, gave them my debt, and I'm out. And that's that's like VC returns in Africa. No currency hedging because it's a naturally hedged business. So all went well. Now I've given you 2, sides of the coin, just completely opposing. One that went really bad. I'm sure it'll come back up, but it's been a struggle. It's still a PE sale, the first activity, right? I still need to go to TPG and kind of say, TPG, go buy it, please. So that's not what you want. You want to list it and you want to go sleep. So those are the type of challenges. You're in an environment that is so varied. You need to kind of be, eyes open in every step of the way. You can do a pure debt model and still get it wrong. We invested in Atlas Mara. I don't know if the guys are listening, but they've been pretty crafty, right? This is Bob Diamond's vehicle. This is Fairfax, the largest insurance group listed in Canada, now backed by Helios. We had $18 million out to them, 8 million paid out, 11 million still outstanding. You can't be in the financial sector in Africa, be one of the biggest guys coming, from outside, going in, saying, oh, I've got a SPAC and I'm going to build the African banking system and do that to creditors. It's reputational disgrace, right, to the sector. Now, what happens as a consequence of Greensill going under, of Atlas Mara going under? It's reputational damage to what Bogolo said. You're creating an image of Africa, and then things like this happens. Chase Bank happens. UT Bank in Ghana happens, where even depositors are struggling. That's what you don't want. So you want stable organizations supporting the infrastructure rather than hurting the infrastructure. So what works, what doesn't, you just have to keep your eyes open and obviously pray a lot. And yeah, hopefully it works well. And then obviously go to E if nothing works.
That's an absolutely great setup for you, E. I mean, you can start a consultancy on, how to make things work in Africa. This leads to my next question for you, E. You're definitely very passionate about sort of leveraging the networks within the system and doing the work, as you put it. What areas do you see as currently being attractive, high growth areas in your opinion? Can you share some of your insights on that topic with us? Sorry, you're on mute. Oh, I think.
Sorry about that. Sorry. My general mental model when it comes to on the continent. Can you hear me?
Yes, we can hear you now.
Hello, can you hear me?
Yes, we can hear you perfectly.
Okay, sorry about that. I said my general mental model on the highest potential areas is generally shaped by the opportunities that are embedded in the challenges that we face. So if you're looking at, for example, just pick one random one, talent, right? We're going to be more than half of the world's working population in the next 15 years. And we have the highest number of kids out of school. That's a challenge. Some people would look at that and be like, this is a hopeless situation. I'm off to Mars. But I look at that and I say, if you can find a way to like reinvent learning so that people can go from no concept of school as quickly as possible to learning a particular skill that can be valuable in a globalized and technologically connected world. That is an enormous opportunity. You can make a lot of money doing that. Infrastructure, right? The traditional mental model for infrastructure, and this is where perhaps I slightly disagree with some of the other panelists about things like, let's find patient capital and so on and so forth. It's a development mindset, and I understand it because I came from that world. But I often think that we also stand the risk of lowering the bar for ourselves. I can't count how many conversations I've been in where they're like, oh, we shouldn't hope for unicorns. Let's settle with zebras and gazelles. And now a unicorn has happened and now everyone's like, oh, unicorn, everybody. But it's how it works. But my mindset is, look at something like digital and physical infrastructure. In Nigeria, despite how quote unquote giant it is, we have literally all the pipes landing in 100-kilometer radius on the coast of Lagos. And the Southeast, which is one of the largest metropolis on the continent, and also 80 million people are unserved, even though we have it's even closer to land a cable in Eket, for example, than to land one in Lagos. You understand what I'm saying? You look at what Starlink is doing. Nightcom Sachs could have done that eons ago, launching satellites to ensure the North has internet connectivity. And that's just on the digital infrastructure side. On physical infrastructure, we're not getting creative enough about building roads, about building bridges, about building new transport forms. Sure, okay, maybe we cannot do subways, but can we do cable cars? We're not ambitious enough about those type of things, right? Then you look at mass reach, which is what I like to call it, mass reach or media. Now, Africa is a hotbed of cultural exports, right? But we serve it for cheap to the rest of the world, or we structure the intellectual property in London or in New York, right? As in the case of Fela's archives. Yeah. Meanwhile, the whole world enjoys our music and our movies, and we haven't actually done the work of like actually figuring out, okay, how do we make this cultural export worth the while? How do we build out the full value chain of this cultural export instead of leaving that to Warner Bros. And Sony, right? There's a huge opportunity there. The environment is another huge opportunity. We are the people who are directly suffering the impact of climate change, desertification, carbon sequestration. For God's sakes, we're still flaring gas in Bonny. 50 something years later. So when we talk about, if we're talking carbon credits, Africa is literally just like swimming in carbon credits that it can actually claim. If we stopped flaring gas in Bonny, we would have enough carbon credits, I'm sure, to fund 3 times our budgets, right? So I'm just saying, like, I just feel like the problem with capital on the continent is it lacks ambition because it has no mission, right? It's just about making money for the bankers, make 5 cents here, make 10 cents here. And it's like, how long are you gonna do that for? How long do you really have to do that for? And until we have capital in ambitious people's hands, we're gonna keep doing this nickeling and diming of focusing on cheap debt, securing cheap debt to sell high in Africa, right? Rather than solve the structural issues, or telling people to be patient while they give us free money. And both of them are just false choices, in my opinion.
Yeah, I think, wow. The common thread with a lot of the things you've said is actually doing the basic work to have a functioning 21st century economy, fixing infrastructure, fixing education, and also viewing that those challenges as opportunities is key. But just in closing, I think this has been a wonderful conversation. I want, this question is for everybody. If we could just start with Bogolo, move to Kirtika, Iyi, and then Saad. So here's the question. What's your counterintuitive, wild prediction about the future of raising capital for innovators and entrepreneurs in Africa over the next 5 years? Bogolo, sorry to put you on the spot.
You know what, actually, because you put me on the spot, I'm going to pass the spot on to somebody else, given just how bold he's been talking. And I like all the ideas that he said. I associate with those. And of course, we want unicorns, but I want to hear what he thinks would be counterintuitive at this particular moment. And then I'm going to completely talk about something different, if you allow me.
All right, hot seat E.
Okay, I mean, I'll tell you, we're doing it. So I'm not just saying it, we're making it possible, because I feel like the funniest thing about the future is it only happens if you make it, right? You can predict it all you want, but it's only when you build it, it happens. I think venture capital in Africa will be a retail product. So I think, in the US, like development agencies are having a field day, collecting free money and sitting on it. And the banks are having a field day, getting free money for the government and making as much money as they can on it. But I think at the end of the day, people are literally going to say, these people don't care about my problems. I do. So I'm just going to pull together funding from a few of my friends and fund this innovator who's really mission-driven about solving my problems. And then development capital and the banks would chase those innovators. And they may or may not be able to actually deploy capital. And in a few years, all those capital pools will completely dry up and cease to exist.
Okay, so venture capital becomes a commodity. Bogolo, he's passed it back to you.
Okay, so I actually want to touch on something a little different, because I think the financiers are here. I want to say, as we see a change in trade in the continent, the capital will start to flow. And we are going to show just the strength of the trading market in the continent and the strength of the capital market in the continent as we work towards the AFCFTA and strengthening our continental free trade agreements and the way that we just interact with each other within the continent. And for me, what I think the AFCFTA will do once we start talking about protocol on investment is that we will start to see that illicit financial flows and African capital that was going outside the continent coming back in and really helping to develop and be as ambitious as E wants it to be, because we've started seeing even the the private sector, the billionaires, the people with capital, really grouping towards what the opportunities will be as the continent unifies around trade, and as we work towards improving investor protection and capital in the continent together as governments, which I think will be very important.
Excellent. Kirtika, Saad, just 2 lines very quickly, please.
Sure, yeah, I mean, I'm really interested in seeing South-South and emerging market collaboration, both in terms of capital as well as shared learnings.
Excellent.
I'm gonna spin E's point. I just don't want to see VC being a commodity. I want to see all forms of funding become commoditized, especially the stock markets, and that's really easy to do. You have the Robin Hoods, etc. of this world. They can easily go and deploy that in Africa and become a very revolutionized product. Bring that liquidity in the secondary market. You have evolved Africa as a continent. That'll be my 2 cents.
Awesome, awesome. I think the common thread here is brighter days ahead for funding for innovators and entrepreneurs on the continent. I would like to say thank you to, you've been an absolutely amazing cast of panelists. I think everyone has learned a lot. And yeah, hopefully we get to convene